Welcome, guys, to our fifth podcast in the Indian Market Story series, where we're really happy to have you join us, and we're hoping, every week we're able to bring you engaging and exciting content. And I think we've got some really interesting things planned for this week as well. Absolutely. And some really interesting stories that we want to talk about. But before we jump into what we have planned, what's been going on in markets this last week? I mean, has it been great, up and down, bad? What's been going on?
So I think it's been more or less a flat week, but of course, last two trading sessions were exceptionally good. And being the first week of the month, we had a lot of momentum data coming through, like automobile sales, GST numbers. I think those GST number was really impressive at 12% higher year on year. And then we had the auto numbers, which were slightly softer than usual, especially exports have been hit across the board. Domestic market holding up, but still semiconductor shortages persisting. But clearly, I think the sentiment was set by the way the Adani Group stocks moved. I think they continue to remain very much in the news, and they are really driving trader volume as well as investor interest at this point of time. And fortunately, I think they had some positive news flow over there, where they were able to raise some funds, and there was a large block deal also, whereby a very marquee investor came in to invest.
GQG Partners.
That's right. I think it's a very positive development for the Adani Group, and does kind of build a bit of a floor on the stock price as of now.
Yeah, I mean, other really interesting topics I think that came across in these last couple of weeks. I think Vedanta was in a lot of trouble for a little while. Vodafone Idea has also been in trouble for a little while. I think Vedanta in particular, there was a lot of concern that the parent company, which is I think Vedanta Resources, would not be able to repay the debt that they've taken.
Oh, please, let's not get into that. It's still a very, very solid company with a very decent credit rating. But yes, I think that's true for all high debt companies, that in times like this, when money is really tight globally and in India, and if you have debt to roll over, then it does cause a bit of a consternation amongst the investors. So I think that's what's happened over there. But Varun, if I could just give a minute or two about what is the correlation between debt market and equity market, and how that actual phenomena plays out, is something which is very interesting, and I'm sure the viewers would like to hear it. So first of all, Varun, I have great respect for the players in the debt market. They somehow always get it right. They are prescient. They get the problems in the economy with the companies well before the stock market comes to know. The global financial crisis of 2008 was predicted first by the debt market specialist, and we were all very bullish, but then the problems unfolded accordingly. So what happens in the debt market is that somehow they sense if a company is in trouble by looking at the kind of bond rates of that company and at what rate they can insure the debt. And there are other network effects within the debt market, whereby the debt market players, the investors, come to know if a company is in a bit of a trouble spot. I think that's what happened with Vedanta over here, that there was a sense that they may have a challenge in rolling over their debt. It doesn't mean that the company is defaulting, it just means that the interest rates may be higher, they may not get as much interest as before. Mm-hmm. So it's a bit of a challenge over there. And I think that's what played on the minds of the equity investors. And then we had the traders coming into play, and they just kind of,
I think as soon as traders come into play, that's when the momentum for a stock really compounds,
exactly,
right?
Yeah,
so
absolutely.
At that point, you're not really looking at whatever the fundamentals are. It's just going to move higher and further in whatever direction is already moving.
Absolutely, I think that's what has happened over here.
So that's I guess the theme of the podcast today is how debt really consumes companies and eventually eats them up. So I guess, to take a step back, why is debt, I guess, the kiss of death for so many companies? Why does it really, as an investor, why should we be avoiding highly indebted companies as a principle or as a concept?
See, I think ever since the markets have been around, high debt companies have been perceived to be high risk companies. There's no two ways about it. And the reason for that is that you're taking on high debt because your basic business model is more capital intensive. And if a business model is more capital intensive, then your return on capital, return on equity is going to be lower. And therefore, it's not such an outstanding business if you have to keep on investing capital to generate growth. And actually, the best value creators, the multi-bagger stocks, are the ones which can create a great deal of revenue, profits, volume, growth without taking on too much debt.
Yeah.
So
So it's almost, I guess, what you're saying is if a company has, I guess, 100 rupees in capital requirements, if a lot of that is on debt, if 80 out of that 100 rupees is financed through debt, then the returns left from those cash flows left for the equity capital holders is very little.
That's right. And also the other issue is, this rolling over of debt, servicing it. And if it's a cyclical industry as Vedanta is, then in the down cycle, the cash flows get impacted and you still have the expansion plans underway. You cannot just stop them in between. And therefore the cash flow comes under strain and you have to borrow more to just pay interest. So there is a risk of a company which has got high debt to get into a debt trap.
Yeah, so it's the inflexibility of that of those interest payments as well, right?
Exactly.
If you're
a fixed cost.
Yeah, if you're an equity holder in a highly cyclical, then your dividend payouts, whatever cash flows you're generating, it can go up, it can go down, and the price of the stock may go up, may go down, but it doesn't really affect your cash flows. But if you've got a lot of debt, if your cash flows are volatile, then all of a sudden to service that interest in a downtime, that becomes a compounding problem.
It becomes a big challenge for the CFO.
Yeah.
So I'm really, I don't want the CFO job of Vedanta at this point of time. I think they have got many challenges. But I'll tell you one thing, that Mr. Anil Agarwal is a very savvy entrepreneur. He has survived many such challenges in his life and come out much stronger. So I'm sure this is just a passing phase for Vedanta. But let's talk about other companies.
Yeah. So, actually, I guess before we move on to other companies, I want to dig into Vedanta a little bit. Maybe let's try and give our viewers a sense of what it is that's actually happening, where it is that the cash lies, where it is the problems are emerging, and what those problems look like. So I guess just to summarize the situation, the parent entity has a lot of debt on its books. And they have two companies in which they have substantial holdings. Hindustan Zinc, which they hold 65%.
That's to the Indian company Vedanta Limited.
Yeah, and Vedanta Limited. And from what I understand of the situation, they have cash lying in Hindustan Zinc, but their debt is on the parent company.
Exactly.
And the challenge is, how do you move that cash from Hindustan Zinc to the parent company, particularly without upsetting the minority shareholder in Hindustan
Zinc, which
is the government of India. Yeah.
So that's a bit of a challenge, and they've been trying to work around it. In the past, they had passed a resolution for plain vanilla debt from Hindustan Zinc to the Vedanta, the holding company, but that was very badly received by the investors, and that particular plan was just squashed completely. And now the recent proposal is to sell the international zinc business to Hindustan Zinc, but that also the government has shown objection to, which I think was the trigger for the stock price to go down.
And I mean, just I guess to expand on that a little bit, because I was looking at the data historically over the last year and a half of particularly zinc prices, copper prices, raw metal prices, because this is obviously a cyclical business. And in the last year and a half, particularly, there's, because of inflation, because of supply chain constraints, these raw material prices have been relatively elevated. So I think the challenge here is the international zinc assets of Vedanta Resources. At least the value at which they want to sell them to Hindustan Zinc, from what I understand, is they're relatively overvalued. They're trying to take more cash out of Hindustan Zinc than what those assets that Hindustan Zinc are buying is worth. Is that an accurate assessment of the situation?
See, Varun, I have not gone so deep into it, because generally my view has been very negative on all these commodity companies, and we generally avoid them in our portfolios because of the cyclicality and the uncertainties around the kind of returns that they can generate. But when it comes to such related party transactions, the street does view it with a lot of suspicion, and I think that's what has happened over here. But to give credit to the management, when the upcycle was there 2-3 years, they had managed to reduce a lot of debt, and they had used the cash flows quite diligently to improve the quality of the balance sheet. But still, on a total quantum basis, the debt is still, I think, about 11 billion, if I'm not mistaken, at the holding company level as on September 22. And they, of course, want to reduce it, but that's kind of work in progress just now.
Yeah. Well, I mean, do you see any ways out of this situation for Vedanta? Because it's not at least from the outsider's perspective, it's not a case of the money not being there within the overall, network of entities. It's the question of how do you move money in an efficient way between those entities to service that debt? Is that, I mean, so I guess what's the path forward here?
See, I think it's very challenging to get the money out from Hindustan Zinc. But eventually, I think the debt markets will come to the rescue. The cost of interest, the cost of debt, the interest rates may go up for the Vedanta group, but they are, I would say, not that over leveraged that they will not be able to manage this particular situation they are in. So I'm pretty optimistic of the group, and frankly, I think the way the stock price has corrected, it may provide a bit of a trading opportunity if you see a mild improvement in the end product prices. But that's something which a trader is better off. But we are catering more to the investors here.
All right. So I guess moving on from Vedanta, let's talk about I guess cases when this has gone wrong, and looking at the recent newsflow, Vodafone Idea is a company in particular where I guess ever since Jio launched, things have gone quite badly wrong for them.
Yeah, absolutely. I think the merger of Vodafone and Idea was really very well received by the market. It created a giant telecom company with 40% thereabout market share. And
about 400 million subscribers
exactly.
at the point of merger, I believe.
That's right. But then Reliance Jio came in. And Jio followed this strategy of offering free services, free data, free calling. And that they were able to gain huge market share from Bharti Airtel and more so from Vodafone, because they just could not compete with a free service. And they would bundle it with the actual telephone, the cell phone as well. And Reliance Jio was very aggressive when it came to marketing. And eventually they got the market share, and then they started charging for the plans. But by then I think Vodafone was already in a lot of trouble.
Yeah.
Now, there are 2-3 very important elements to understand about the Vodafone journey. For one, the parent company, or the partner company, Vodafone PLC UK, they have had a very bad experience in India because they were charged capital gains in one of the transactions they did. And even after they won in the Supreme Court, the government went and changed the act, and they got into.
I think it was that retroactive taxation case.
So that because of that, Vodafone management took a categorical decision that this is it. We are not going to invest any more in any Indian venture at all. And to the extent that they have a stake in Indus Towers, and there was a proposal that you sell the stake in Indus Towers because that's a nice solvent company, it's got great dynamics, and use that money to invest into Vodafone Idea. But still they're not, inclined to do that. And that's the big problem, because while the Birla Group may be looking at investing, and they have committed to invest 5,000 crores, but Vodafone is just not.
5,000 crores is a drop in the bucket. I mean, if you look at the overall capital requirements of Vodafone Idea, I believe they owe about over 50,000 crores to the government, and there's a demand for an additional 50,000 crores to build up 5G infrastructure. So I don't see how 5,000 crores. I mean, it seems like a.
Yeah, that's right. But it's capital, and they can leverage it, which is what they are trying. And then, once you get the ball rolling, you can get external institutional investors to invest in the equity of the company. But really, I'm very, very disappointed with the way Vodafone has played out. And clearly, I think the government did step in with many steps and many kind of solutions.
I think they're now the largest shareholder, or will be the largest shareholder once they convert that debt to equity.
Right. But I do not see a way out for Vodafone over here. And we have to be really open to the fact that the company may go under, and then the subscribers may have to cart themselves into some of the existing operators, because there's only so much the government will do, and if it doesn't get money very quickly, then there's going to be more trouble over there. And the stock price clearly is reflecting it. The government bought it at 10 rupees, but still the stock is trading at sub 7 rupees. So it's a challenging time for Vodafone, and it's a classic case where there was a lot of debt on the company, a lot of requirement to invest in the capital assets at a time when the industry was facing intense competition. So like a perfect storm for Vodafone. High debt, need to invest in the capital, in capital equipment, and your cash flows were getting smashed. Your subscribers you were losing on a monthly basis. So I think everything which could go wrong went wrong for Vodafone, unfortunately.
Yeah. Well, I guess that's the Vodafone story.
That's right.
But it's not always a perfect storm of events. It seems like that forces debt onto a company and causes it to go under. I think another example that we've spoken about, where it's not necessarily the company that goes wrong, but the promoters' decisions that go wrong, is Zee Group.
That's right.
Zee Group
really
is a
unfortunate story.
terribly unfortunate story.
So Mr. Subhash Chandra is quite a visionary. He got India's first terrestrial channel, the Zee.
What's
channel.
terrestrial
means from the satellite straight beamed onto your set-top box and into your homes. And that was the first time we could have a choice of channels, and private sector went into media in a big way. And back in 2000, Zee was really one of the top performing stocks at that point of time in the TMT boom. And they had got the entire market really rooting for them, because they were ahead of their times. And they kept on investing a lot into Zee. But the problem really started when the management started to look at investing into infrastructure. But that was not in the books of the Zee, the listed company Zee Entertainment. It was in their personal private companies. And when they could not service those debts, that is when they had to use their stake in Zee to service those debts. A lot of it then got sold off as well to repay those debts. And as of now, the Subhash Chandra Group hardly has any holding in Zee. It is entirely borne by the institutions. And one institution, Invesco, was very disappointed with the returns, and therefore they wanted to eject the present CEO, Puneet Goenka. And the only choice therefore left for Puneet was to get a merger into Sony. And that's what I think the way it played out over there. So they're looking at merging into Sony, but that's getting delayed continuously. In the meantime, there's a huge disruption within the media industry because of OTT players. And Zee's performance also has been subpar. Advertising revenues have lagged. So although Zee Entertainment still has a I would say decent future, the promoters, I think they are.
It's such a shame, because if you think about it from almost a 1,000-foot perspective, if you step back, right, over the next 10-20 years, just the demand for entertainment at a human level is going to continue to go up. And if the promoters had just waited a little bit, they could have used that capital and reinvested into Zee, and they could be a leading OTT player at this point.
Bad decision. One other bad decision comes to mind is what happened with Vijay Mallya when he got into aviation. He also lost his companies, and those were gems.
Yeah.
United Breweries, United Spirits were gems.
They were cash cows, if I'm not mistaken. Yeah, and they built brands that lasted several generations. Kingfisher is evergreen brand in India.
Absolutely. So that's another case of bad decision making by a promoter, as was the case with Mr. Subhash Chandra as well.
Well, I mean, that's not the only case. I mean, it seems like there's this pattern here. But, one story that I want to touch on is the tale of two brothers almost. The Reliance Industries and Reliance ADAG, where you had, both companies started out with a lot of debt. One is quite obviously withered away and is not quite prominent, and the other is flying high. Why don't we break down what happened with Reliance ADAG, I guess, to understand, where things went wrong and what bad decisions were made, and sort of try and contrast it with how Reliance Industries sort of pulled themselves out of that debt hole.
That's why I think really the saga between the two brothers and the Reliance Group is a fabulous case study for all family-run businesses, as well as from a management and a financial perspective as well. So, after the demise of Dhirubhai Ambani, who was a leading entrepreneur and created a great deal of wealth, there was a split in the empire. It was an equal split, where Reliance Industries went to Mukesh Ambani, and the telecom business, the power business, and the financial services business, that went to Anilambani. But those businesses were smaller than the pure refining, plastic, the oil to chemical business of Reliance Industries. So there was a lot of capital or cash also given to Anil Ambani and the Anil Ambani group companies, so that he could use that particular cash to grow the businesses, to acquire new businesses. And at some point of time, I was there when the Anil Ambani group was born, and Mr. Anil Ambani came on the stage and announced sort of his business plan and his vision. And I clearly remember him saying that the sunrise industries were the financial services industry with Reliance Capital with him, and the telecom industry. And he was very positive on the media industry. So these were sunrise industries. At that point of time, there was a lot of investor interest and a lot of fancy around these businesses because they had great growth momentum. But what happened was a complete nightmare for the ADAG group companies. And the real reason for that, if you were to pin it down, is cash flows. So while the split was equal on asset basis, maybe on profit basis, and whichever parameter, but Reliance Industries had the cash flow from the refining and the plastics business. And the Anil Ambani group companies were always negative cash flow because the businesses were such, they were nascent businesses, they need a lot of investment, and there were certain regulatory constraints as well, especially in Reliance Power, which was in Reliance Infrastructure as well. So the power infrastructure was highly capital intensive. Telecom business also capital intensive and a lot of competition coming in over there. Media business was not that big a pie, but nonetheless, it required its own capital and it required its own servicing over there. So what happened was that because of the lack of cash flows, the companies got into a debt trap. And one by one.
So I have a question here in particular, because I remember this saga playing out in the Supreme Court as well.
That's right.
Because we talk a lot about the cash flows, and I believe one of the key agreements was that Reliance Industries would supply gas to Reliance Power at, I think, 2.4 something.
That's right, yeah.
Dollars per MMBTU. But the government price set was $4.2 per MMBTU. And I mean, it seems to me like that decision in particular effectively shifted a lot of cash flow from what could have been, Reliance Power's cash flows to fund their growth to Reliance Industries. Do you think
that was a big setback, Varun, no doubt, but there were a lot of mistakes made also. And unfortunately, the telecom business also got hit by intense competition, and eventually Reliance Industries also got into the fray over there. Mm-hmm. And of course, the entire power business was impacted because of this particular issue. And power is a long gestation business, and a lot of constraints are there, a lot of controls are there at what price you can sell the power. You needed power purchase agreements. There were delays in implementation.
A lot of very working capital intensive, because I guess your key purchases are the discoms, and they're not going to pay out until the dogs come home.
Exactly. So a lot of things went wrong, and banks, investors, all of us took a hit because of, I would say, bad fortune and mistakes combined together, which resulted in the ADAG group completely imploding.
Really sad story, but I guess maybe let's contrast it with how those cash flows are used by Reliance Industries, because Reliance Industries in particular is flying high right now.
Yeah,
so
absolutely.
How exactly did Reliance Industries get out of that and avoid that debt trap completely?
So the thing about Reliance Industries is that you have to hand it over to Mukesh Bhai, truly a visionary and a clear successor to Dhirubhai, where Reliance Industries for many years also was under the kind of a cloud of debt. Not that they had any problem servicing their debt ever, but the street always perceived that the balance sheet had too much debt on its books, and the return on equity, return on capital was on the lower side. And Reliance Industries was adding capital assets at a breakneck speed. They're invested very heavily into telecom. They're invested very heavily into retail as well, and that had taken up a lot of capital of the company. And therefore, the stock price for many years, I think, went sideways. Almost 8 to 10 years went.
I think
nowhere.
from 08 to 2017 almost, it
That's right.
pretty much went nowhere.
That's right. 17, 18, because the markets did well, it of course did well as well, the stock. But the inflection point was from 2019-20 onwards, and the clear inflection point was when he started selling stake, first in Reliance Jio and thereafter in Reliance Retail as well, to a clutch of foreign investors and strategic investors like Facebook, and very marquee investors came.
I believe, I don't remember this accurately, but I believe there was a point when Aramco was very interested in investing in Reliance Industries.
That didn't work out. That didn't work out. You're nice to remember, but it's always in the past now. That didn't work out because Aramco had its own set of issues, and then the oil markets also went into a tizzy. But that was the smartest thing which Reliance Industries did, is to dilute capital at very fair valuations. And all of a sudden, we all discovered the kind of value that was created. It deleveraged the balance sheet significantly, and then you've seen the stock price go up 5-6 times or so.
Hopefully our viewers at this point will hopefully try and put it up, but hopefully at this point our viewers will be able to see how over the last 10-12 years, how the price of Reliance Industries has grown exponentially, in particular when their debt to equity has came down.
That's right.
So hopefully we'll be able to put that up. But yeah, that brings me to, I guess, the final point of discussion for our podcast today. Really bringing it full circle back to Adani and the news that they've raised 15,000 crores, I think 1.9 billion from GQG Partners. It seems almost like they're replicating that strategy of equity dilution.
That's a very keen observation, that they were also trying to go the Reliance way, where they had created assets, just as Reliance had created Reliance Jio and had created Reliance Retail. They had created a whole host of assets, performing assets, and it was a lot out of debt, no doubt about that. But now they were trying to raise equity so that they could improve the quality of the balance sheet and reduce some of the debt, and thereby improve the profitability. And the IPO in Adani Enterprises was a step in that direction.
The FPO, you mean? Yeah.
But that didn't work out, and then rest is history, I guess, at this point.
But you know what I guess I find really interesting is I think the FPO target was 20,000 crores, nearly $2 billion. And I think that would have reduced their overall group debt by about 10-12%. And obviously that's not really gone anywhere. But against that, they've raised $1.9 billion is through direct stake sale, which will effectively reduce group debt by about 10% at a much worse valuation for the founders. But still, it seems like that impact of that failed FPO. Is it fair to say that that's almost sort of disappeared from a financial perspective, or is it still pertinent?
See, I think that this particular transaction with GQE is a very important one, and it could get followed up with many such transactions. And if they're able to get the sovereign funds and some of the marquee investors to invest directly in the company or acquire stake from the Adani family, then I think a lot of the fears around Adani Group will recede. I mean, let's just put the Adani problem in perspective. Forget about all the regulatory issues which are there. There are two problems from market perspective: high debt, high valuation. High valuation, part of it has got corrected, but I still think there's a long way to go over there. But a lot of it may come because of rising profits over 2-3 year period. And high debt is something which has to be managed through equity dilutions, fresh capital raising, especially at a time when debt markets are under constraint the way they are. And we spoke about Vedanta Group. One of the problems is because of the debt market. So let's see how that plays out. And if I think they're able to manage raising capital, equity capital, then I think they would be out of the woods.
Well, I think That's a great note to end this podcast on, because there's a lot for our viewers to wait and watch in the coming months and weeks. And hopefully we'll check in next time round on how Vedanta has done and what they've managed to overcome this.
But I'll tell you, I want to end on one note. The thump on the table. Before investing in companies which have got high debt, be extremely cautious and careful. And I would say that you want to bat on wickets which favor the investor, and those wickets, if you were to name equate them to companies, they are companies with low debt and high return on equity.
Fantastic. Let's end it on that note. And it seems like our key takeaway. Well, we hope you enjoyed the podcast, and we hope there's some really interesting insights for everyone to take from this. And we'll see you next time.
Absolutely. Look forward to your feedback.